to your Second Life experiment, and no one knows if it's going to take off or not. And to be honest, one other thing about the metaverse, if the metaverse takes off, I think I'm going to be liable to get on board with whatever metaverse company is not Facebook.
This podcast contains the arguably witty banter of two friends, Skippy and Dougals, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
You're looking posh today.
I mean, I only wear designer brands over here.
You are like deep value to the core. Your designer brand is Kirkland. Nothing wrong. So true. Nothing wrong with that. I'm just trying to call a spade over here.
Thank you. I appreciate that. Yeah. In the pre-show meeting, I was telling you about the things I'm buying off eBay to wear because it's the cheapest market around. So good point. How are you?
I'm excited for this conversation. There's a good amount of momentum going on that would be good to chat about. And actually, before I even get into the first thing, which is unrelated to investing,
okay,
but captured my attention, this week was quite, for me, a fascinating week to watch in the market. It was a big week this week, or material week this week, but even like the month of October, actually, S&P was up something like 7%, right? Like a material month. But with this week, what felt fascinating to me was this very well is likely to be wrong because markets are random, but it's like this crescendo. Crescendo being the top of like the musical score when it's at the end and then like, boom, right? Where you have this backdrop of all the conversations that are happening about nonsense occurring, right?
Mm-hmm.
Supply chains finally caught up to Apple.
Oh, yeah.
Right?
Which Apple's like, I mean, I say this tongue in cheek, but I'm pretty sure Apple's like murdering people in alleys to keep the supply chain going because that's Tim Cook's thing. Like, that's how he feels. That he's the best company in the world.
Just for the record, I'm going to speak for Skippy and say that I do not believe that he believes that murdering people in alleys is Tim Cook's thing for any reason.
Okay, let me backtrack that. I think Apple will go to great lengths to ensure that their supply chain is not disrupted. And I would not be surprised if sometimes that goes outside of the law. I want to take back my incredibly rash statement because I don't believe that. But yes, that's the company that you go, when it reaches Apple, holy cow, there's no place to hide.
Yep, exactly. So we'll see. Speaking of, here's where I'm going to kick it off. A little non-investing fishbowl piece of fascination that caught my eye. Speaking of companies that are going to great lengths. Are you familiar with A&W?
So familiar. I mean, I had a family member that ate at A&W every day for 20 years straight, and I would join him on some of those adventures. So very familiar. I'm like the world's foremost expert on this.
Let's bring that up a bit later as well, that particular point.
Yeah.
So what I'm going to talk about today is, let's frame this as math is important. Okay. It is important that people are able to do basic math. All right. And sometimes as my 8-year-old now, is doing like real math in school, and it can seem like irrelevant to everyday life. However, math's important. So how does this relate to A&W? I'm going to take you back about 40 years to the 1980s. Back then, right, you got the battle of the fast food chains that was happening, and our good friend McDonald's came out with the quarter pounder, sometimes a quarter pounder with cheese. In the US, the Royale with cheese, apparently, if you go overseas.
No, not in the US, in the UK.
The quarter pounder with cheese?
No, just keep going.
Yeah. Anyway, so they came out with the quarter pounder. So it was all the rage. People buying quarter pounders, quarter pound meat in people's faces galore. So A&W says, we can do you one better. We're going to keep the price the same, but we're going to launch the 1/3 pounder. Same price, more burger. So they had this campaign. Third is the word was the campaign. Ooh. They come out with it. They roll it out. They hit in the streets, right? They're like, they got their marketing firm juices going, all excited, watching the cash roll in, ready for it, refresh. that B of A account. Well, B of A wasn't around back then, but they
They did
refreshed that
math
bank
wrong.
account. Yeah. And no dollars came in. Refresh it again. No dollars. It didn't sell. So they couldn't figure out what the heck why. Like, we're giving you more for less. Classic. And so they did focus groups and everything. And you are exactly right. It turned out that people were like, why would I pay the same price for less of a burger? I get 1.4 over here. You trying to give me 1.3? Right. So anyway, so it didn't sell. But now the reason this came up this week is because A&W said we're trying again. Like, we believe over the past 40 years, the U.S. educational system has improved, and they're going one step further and not just rolling out the 1/3 pounder. They're rolling out the 3/9 pounder.
They did focus group testing, and they think 3/9 is better or something.
Well, I don't know if how deep they went there, but if there's anything that says that it will be, it's because 9 is greater than 4. And so they needed a denominator in this thing that had a bigger number than the 4, is my guess as to why they did it. But I'm curious as to whether maths.
All right. I mean, just a free consulting session for A&W right now. It should be called something like the 4th pound plus, or something really simple. So you don't even have to, or you could say like, whatever that percentage is, like, X% bigger than a 4th pounder. And so you don't confuse people. I don't think 3/9 is really going to move the needle on this.
What about 9/27?
No. But here's the thing. What happened over the last 40 years is like, I don't really desire to have a 1/3 pound meat in my face. Like, I might even want less than a 1/4 pounder. So there's too many variables changing here. I'm interested to see the results, but I just don't know.
Time will tell. Time will tell. We shall see. All right, I'm going to roll this into an investing related topic. And you provided the perfect transition earlier when you were talking about the daily A&W meals that your family member had. So there's an article that came out, a post that came out called Risking Fast and Slow. It's in Of Dollars and Data. Nick Majuli, I think is how you pronounce his name. I enjoy Nick's posts generally. This one, Risking Fast and Slow, was talking about 2 kinds of risk: fast risk and slow risk. So basically, what he's saying is that fast risk is a risk that hits you in an instant, and slow risk is one that accumulates over time. So the examples of fast risk that he give are like driving without a seatbelt, cheating on your spouse, using too much leverage, because they can all result in like immediate consequences. So you get like death, divorce, going broke, right? It's, you take this risk, consequence immediate. Then you get slow risk, which is like not eating right. Let me not judge. I was saying that potentially going to A&W every day may not be eating right. Do that over the course of 20 years, right? It's something that catches up to you. Like, you get heart disease or whatever eventually, right? In the spousal situation, neglecting your spouse, right? That takes years, potentially to come. Or the investing one he said was waiting to buy the dip in the stock market. So like, it feels like you're doing something less risky, but now you're just sitting, in cash all the time. What he said, that makes sense? The definitions there?
And I know folks that have got stuck in cash, gosh, for like the last 8 or 9 years in a way, because they got petrified with this. The crash happened in 08, 09, and so, they got scared. And then when things turned, they weren't sure if they ever turned. And then it went from, have we really recovered, to, is it too frothy? Then you could make an argument since like 2013 it's been too frothy, which is hilarious, and look at what's happened over there. So I think a lot of people can relate to that psychological component.
In day to day, people mostly talk about fast risk, right? Like that's when we say the word risk, is generally talking about fast risk. One thing that was like a really notable point in here is he said that stocks have lots of fast risk, but little slow risk. And so like the facts we can point to here, if you look at the US stock market, right, it could drop 35% over a 5 to 6 week period. Look at, the February to March of 2020, right? You can drop real quick, fast risk. But the US stock market has never lost money over any 20-year period. And so lots of fast risk, very little slow risk. And so the main point he's trying to make is that in the past, we've often unknowingly or unintentionally, like, we trade slow risk for fast risk because we don't talk enough about slow risk. So like we want to, as I mentioned before, you want to avoid risk, so you sit in cash, right? So what's your take on that? And then I'll throw out a couple other points.
I love this. So I think the person that did this specific topic just brilliantly, the best I've ever seen, is Nick Murray. Have you ever read Simple Wealth, Inevitable Wealth, Douglas?
No. Mm-mm.
Okay, so that's my number one book recommendation for like your people that aren't gonna be into the intelligent investor or like the deeper, even the Peter Lynch stuff, like or the Seth Klarman stuff or the Howard Marks stuff or the Buffett stuff. There's a lot of people that's not even in their wheelhouse. So Simple Wealth, Inevitable Wealth by Nick Murray really does a fabulous job articulating that this slow risk, as Nick would call it in this article, is in a lot of cases it's more risky to hold cash or even bonds than it is to hold stocks, depending on your time horizon. So he'll do simple things in that book, like talk about, hey, this is the cost of a stamp in 1972, and this is the cost of a stamp in 2003. And it really helps hammer home, like, oh, this is what happened to my purchasing power. And it seems safe because the equities market seems scary during that run to put money in there. But if you know that everything you own, that same price purchasing power that's happening with the stamp is happening to all those other things, you can quickly get to the point of being like, oh gosh, I need equity exposure for the long term or I'm going to be in big trouble. Great concepts. I'm
Beautiful.
so happy you brought
Beautiful.
this up.
This next couple points is where the Dougal's brain starts to go. Is he has a line in there where he says, with slow risk, there's no single event that you can point to and say, here's where I went wrong. I agree with the premise of that and where he's coming from. How most of us think, like he's right, that there isn't a thing where you can say it was, if I was smoking for 30 years, it was that cigarette, right? Like it's, you can't quite say that, right? I can see where that brain would go there. However, the way my brain works is I'd challenge it to say that there are single events that people can point to, even if they don't realize that those were the events. It's about, to me, the creation of precedent and establishing a decision-making framework that you can point to as one event, right? It might be the cigarette event might be, I was out on the playground in 10th grade and Janie pulled out a cigarette. And so then it was like the influence. Now you're saying that I'm setting a precedent of peer pressure or, whatever the case might be. It could be in talking about, I have full faith, knowing my own psychology here, that this won't be the case. But last week we were talking about the minuscule option bets, right, that I made so I could understand the mechanics of options. Someone in that case, I'm going to separate this from Dougal's, but someone there could go, okay, so I'm just going to, let's say once a quarter, because it scratches an itch, I'm going to have tiny bets in my portfolio that I bet around on options or on earnings. And like, that won't do anything, right? It's a small part of my portfolio. And then in 5 years, I'm like, but this looks like a real bet. Right. And so it's more, there's like a decision-making framework that was created and a precedent that was created that turns into a gateway, I think is the thing that's kind of missing. And so I believe that it's important that you recognize the single events, even if they are seemingly meaningless on their own, as a precedent that you're setting for yourself or for others in some cases.
I agree. I think I agree like basically 100%, but I'm going to try and say it in a slightly different way. If 20 years from now I'm in really bad health because poor diet and not enough sleep, in my case, that will probably be because I made adjustments to deal with stress of like the pandemic stuff that I let run too long and become habits rather than being like, oh, this is a crazy time, I'm going to relax on XYZ. But I know, and I'm already in the process of trying to adjust back to a more normal diet and everything else, right? And so I think I could tie that slow risk, as Nick would call it, back to an event and a fact that I didn't recognize that event was happening, and to your point, like turned it into a precedent and totally changed my process in a way that had long-term consequences.
Powerful stuff. I think the concepts there are super powerful. All right, what's in your fishbowl?
I mean, should we just briefly talk about Meta? Did you ever watch Silicon Valley on HBO?
Oh, are you kidding me? How many times?
Okay, right. I mean, is this not Hooli? Like this is just Hooli. Go watch the 30-second clip. It is the creepiest thing, and it is 100% out of that show. I could just picture, what is his name? Gavin something.
Yeah, that show is real. Like it's
Yeah.
the show is it's non-exaggerated, like real things that occur.
I don't know, man. I don't know what to do but laugh about it. And I think sometimes humor is the right medicine. It just seems like a massive joke. Watch that video and watch of course, the little thing like spins around and turns into like kind of this infinity logo. It's like, it's so bad.
One thing I've mentioned briefly before is all this stuff. It takes me back to like 10, 12, whatever years ago when I was at Second Life, right? All this stuff is coming back out. We have people, if you have not heard of Second Life, makes a lot of sense.
Yeah.
One, that you haven't, but like go look into it and go back if you can find them on the internet and look at articles from like 2006, 2007 around Second Life when it was blowing up. It is the metaverse, like based off of Snow Crash, right? Back in the 1990s.
Mm-hmm.
And we had our own economy with Linden dollars, which you could say is like the cryptocurrency. We had the equivalent of NFTs back then. You could create things like shirts. You had land, right? Which had code in them, which tied to owners that they could sell, right? It had all of that. Avatars, whatever, right? It was the metaverse. And just seeing all this stuff, whether this turns into a thing and all the NFTs and all this stuff turns into a thing, like we'll see. But it's creeping out the shell.
Does this make me like a grumpy old man that when I hear Zuck's pitch for the metaverse, I go like, why would I even want to participate? Like, that doesn't seem that it's going to bring me like happiness and well-being.
So here was my view back then on it, because the same kinds of conversations were happening back when I was there too. I would say I would refer, when I was talking to some friends, sometimes I'd be like, well, in First Life you go, and they're like, dude, that's just life. Like there's just called life. But it was the same kind of conversations that were happening back then. And where I position this in my head was there are a lot of people, whether it's like a segment of the population or it could be geographic or whatever it might be, that don't have access to other to what like maybe you might have access to day to day. So examples that I like leaned into pretty hard back then was like teenagers. Teenagers were a tiny part of the Second Life population. I ended up leading the strategic initiative, and they became like 20%. Because I said, like, this is a group where expression is big. Being able to like start your own business is like a thing that you can only like really kind of dream of. You don't have the kind of resources, right? The creativity, all that. I think there are populations, right? Or you could look in some international populations, you could see where this type of connection to the rest of the world might not feel as real, right? That you can get another avenue. So I see things like that. I think that there could also be implications for the enterprise, for work. Now, Skippy going into the metaverse, I mean, you're buying your long underwear off eBay.
Yeah, it's such a good point.
You know?
No, so I love that perspective. That's a really good point. And I don't mean to throw shade at the people that it might work for. And at some point, I think it would work for me and be intriguing. There's a professor from the University of Chicago, and I can't pronounce his name, but talks about studying flow. And one of the things, flow is like this natural state where the brain excels and people are engaged and happy.
Progressive advertising woman, is that what you're talking about?
Unbelievable. Ruined my whole story. Anyway, there's things about video games, the metaverse, whatever, that can be really beneficial to the way the human brain processes information in terms of having like clear rules and boundaries. And I can see it really working for some folks. I don't know. Maybe I need a more open mind about it. Maybe I should give it a shot.
It's a big bet. It's a big bet.
Can I do my mini rant on, Facebook is a classic growth company. I remember when it IPO'd. I know friends that bought the IPO. This is what drives me crazy about growth investing. So, Dougals, any guesses on your return if you would have bought at IPO, which is roughly 10 years ago?
I'd say 20x.
About 10x. Equity's up about 1,000%, right?
Okay.
Nice turn. No one's going to complain about that. No one that bought the IPO and held it, I imagine, is upset. Here's what they have done though. And here's what a lot of growth companies seem to do that just drives me crazy as a value investor. This is a me issue, not necessarily a Facebook issue. So they're at the point where they're generating $32 billion a year in free cash flow. And the way things are going, it looks like they could turn the switch and even grow that. And instead of saying, oh, we're going to reward our investors, it wouldn't even have to be with a dividend. It could be with a buyback or 1,000 other things, or it could just be spending some of that money to like fully lock down your core businesses that are the ones that are generating that cash flow. Yep. Zuck's like, what's a good size check? Oh, $10 billion? I'm going to spend $10 billion on this passion project of mine that's completely unproven. And people have done it in the past, to your Second Life experiment, and no one knows if it's going to take off or not. And to be honest, one other thing about the metaverse, if the metaverse takes off, I think I'm going to be liable to get on board with whatever metaverse company is not Facebook. Too. Like anyone else has a metaverse, I'm in that side of the equation. So point being, or my frustration is just like, you're at the point where you are a mature, sophisticated, potentially great company with great network effects, and you see that cash flow coming in the door, and now you're like, oh, how can we burn this? Where's a fireplace to throw this? It just drives me crazy, because I think they should be transitioning kind of like a Google or an Apple has done. I mean, Apple had trials and tribulations where their mindset about free cash flow is just going to be different than Facebook's because they had tough times. Facebook's never really had tough times, and that's why I think Zuckerberg doesn't fully understand the gravity of like, oh, I'm just going to spend $10 billion on something I'm into. Do his shareholders support this?
He is the shareholders, so I don't think it matters. I mean, Zuck, I'm pretty sure, still holds control over that organization. Well, I don't know Zuck by any means. He doesn't seem that flippant, though, I would say. And so,
he's very calculated, but that doesn't mean he's
right.
Mistakes.
Yeah, it doesn't mean he's right. But I'm curious. I say that because I'm curious as to, with a name change like this, like this is a really big deal. I wonder what's sitting behind it beyond just his passion project. Like whether or not it turns out to be right. I'm curious as to all the supporting points that go into it. We'll see. I like your I see you like putting out a bid for, I will invest in any organization that is not previously named Facebook that is willing to provide access to the metaverse.
I will. Give me a metaverse that's like 20% as good. If you're not Facebook, I will consider it.
I love it. Oh, I love it. Can I dip in for I'm gonna take a transition of groups of people that maybe didn't have access to use that kind of transition to dive into the fishbowl for something.
Yeah,
that please. Is Black Bitcoin. I was not familiar with all of the, I'll say, organizations and conferences and clubhouse groups, like all of this that were around Black people and cryptocurrencies. Fascinating to me. I read this article last week called Inside the World of Black Bitcoin, where crypto is about making more than just money, is in time, which I also didn't realize that was still around. So this was like just a whole like revelation for me.
And I already put this out on the Twitter at Skippy Dougals because when you passed it my way, I knew there was really something quality here. I knew we'd talking about it on the show, so it's already out there.
It's good stuff. The top line premise of this piece, it's a long one and well worth the read. Please go and read it. Yep. Is that crypto is about liberation, and that's the discussion that's being had here. So a few of the things that caught me by surprise in here, in addition to all the groups, organizations, etc., that are about this, is that unlike the lower participation that we've discussed on here in other investments, surveys show that people of color outpace other groups when it comes to investing in crypto. So a couple stats that were thrown out: about 44% of people who own crypto are people of color, according to a June survey by the University of Chicago's National Opinion Research Center. And the Harris poll showed that 16% of US adults own crypto, but that's 18% for Blacks and 20% for Latinx.
Yep.
I never would have guessed that.
So the thing I loved, I'm gonna try and take a victory lap here, and you're gonna put me in my place. Is I feel like for the last 6 months, I've been telling you about the thing that intrigues me about crypto. One is the technology side and the innovation happening there. I think it's the most interesting place in finance right now, not necessarily the best investment. And then two is that I felt like there was an ability to help people whose financial systems are failing them. And I naturally go to places in Africa or Venezuela or, like places that you think of as more oppressed. But the tilt on this article was about a lot of these individuals, a lot of these black Bitcoin owners feel like the US financial system is holding them back. And this is a way to get a system that doesn't have any of those preconceptions or discriminations built in, and that is really really cool to me.
It's really powerful. I'll give you that victory lap. It
Yes.
also, for me, like I'm so mixed on it, right? So mixed. The issue of like liberation in here is around inequality, as we've
Yeah.
talked about. And there's one point that was made in here that if there was some estimate, I don't know where it comes from, that if current trends continue, the median black household in the US will have zero wealth by 2053. Like, need to combat that. Where I get mixed with this is everything you said, all about it. Love it. It makes sense that like this system was, as was stated in the articles, like built off of our backs. Like we can't trust it.
Yeah.
Right.
Yeah.
Get that. So let's have a system, I'll call it of our own, whether or not it was created, but right. But like system that we feel flexibility and power in. I get that point. There's no reward without risk. But the risk that I'm most fearful of is that that bet is being made on the nascent, unsupported, unregulated, like all of that is where the bet's being made, and it could really burn. Like
Yeah.
that's where the my trepidation around it kind of comes from.
So the thing I loved about this article on with that particular point though is at the end I think they do a really good job tying together how risky this can be, and they interview a bunch of people that say yes there's some promise of there's no heavy hand because it is decentralized, but that doesn't mean it's risk free, that doesn't mean it's a no-brainer. Like none of those things are true. And I, like you, hate to see people put their life savings in something they don't understand. And you can't claim the majority of Americans or the majority of Black Americans understand cryptocurrencies. That's just not the case right now. And so yeah, 100% agree with everything you said. I think that's a huge risk, and I almost lose sleep about it. But it's nice to see some of the positives there because it's a balancing act. There's definitely pros and cons.
Agreed. I love the power in it. Like that, like reading this article, I felt the power from individuals in the article of where they had like don't feel that financial power elsewhere. I love
Yeah.
that. Like it was amazing. One of the little anecdotes that I really enjoyed in this was there was a man that would go and buy his $2 lotto tickets at the corner store and goes in and the lotto machine wasn't there. It's like, where do I get my scratchums? Right.
Yeah.
And they said, well, your machine is right there. And it was a Bitcoin machine, not the lotto machine. So I was like, same, you put your $2 in, you'll get yourself an investment. And it was something like, I can't remember the percent that they had in there, but his $2 got, some fraction of a fraction of like a Bitcoin. It was that I was like, oh, wow. Like that is you change it. You basically say it's a gamble, just like your lotto ticket's a gamble, except it's a gamble where you hold an asset. Like,
Yeah.
it was, I love that little anecdote.
I loved it too. I had these conflicting emotions because the way it read, it was kind of like the dude was coming in to scratch an itch, and there was a machine there, and he so he was gonna put $2 in something, and I felt like initially they could have like put a I don't know. Like I could have been there with a sign that said, "I'll shake your hand for $2," and he would have handed it over. Well, now in retrospect, because Bitcoin has increased, I think what was that like?
Yeah.
That was more than 5 years ago. So I think
Yeah.
if he still owns that Bitcoin, he did very well.
Yeah.
But
Bitcoin's like up 60x since then.
I had a hard time understanding because they talked about the one guy pulled him aside and kind of explained how it worked and explained that it was an acid and everything else. But I couldn't decipher like if he was just he had to get rid of that $2 or if he actually went, oh, this is the future. I love this. I'm making an investment now. Good story regardless.
It's somewhere in between. I don't think they didn't sat down and like read Satoshi's paper and go through the promise of blockchain.
Here's the white paper and
oh man,
do discounted cash flow on the gold market. And,
yeah, exactly.
All right.
All right. What's next in your fishbowl?
Can we both allow ourselves a little rant on how idiotic it would have been to do the unrealized capital gains tax on billionaires that was being discussed earlier this week?
I can bring a different point of view.
Okay, let's do it. Let's hear your different point of view because I was texting you all week and you were withholding information.
I said we got to save this conversation for the pod.
So if anyone's unfamiliar, the Democrats, what are we calling this? Build Back Better bill.
Yep.
Has been reduced from $3.5 trillion in initial conversations down to it's either 1.75 or 1.85. That it seems like the progressive Democrats are holding up another bill, the infrastructure bill, which actually has a little bipartisan support until this bill gets passed. And so this week, as some of the senators in Arizona and West Virginia ask for some of the more progressive measures to be removed, the Democrats scrambled to try and create tax revenue for this. One of the things that was discussed but ultimately did not make the bill because it was roundly criticized was a tax on billionaires. The tax would have affected about 700 people in the United States, and it would have taxed unrealized capital gains, which means the value of equities they hold before they make a sell decision. Okay, so I want to hear your counterpoint.
So my counterpoint is largely, it's actually more of a question. If you look at whether this is good or bad, the question is, what's your goal? Because all the points that you raised in your text, which I thoroughly enjoyed, you were saying things about how this could force, like, how are you going to pay a tax on something you haven't sold if you don't have the cash? You have to then get the cash. Now you're it's like this weird cycle you end up creating. And I think there are like multiple goals. Like I'll name like a few potential ones, but they're like multiple goals that you could have in doing this. You could say I read Howard Marks was making a statement around it and saying how it like will probably end up decreasing investor sentiment if you start introducing things like this. And we have to save the economy. So if you have a goal of like support or save the economy, it's like that's the goal, right? And that like we're looking at that. You could have a goal of decreasing inequality. You could have a goal of increasing investor sentiment, which this would not do. You could have a goal of protecting the wealthy and their taxes, which this would not do. You could have a goal of protecting entrepreneurship, right, in the U.S. and all that. There's a lot of different goals you could have. But if some goals, like if you go back to a pure premise of saying that there are people that have a control over wealth in the country that is accelerating at a rate, you could say, actually, we want to decrease inequality and we want to force sales. Like once you get over a certain point, you wouldn't even have to say unrealized capital gains is what we're taxing. You could just say, if you have assets over this, you must sell them, kind of like we do with IRAs, right? Once you hit a certain point, there's like a minimum distribution. You could do that and just tax capital gains. Like I just think it depends on the goal. But if you do something like this, it's making a statement on like what the US quote unquote stands for right now, which I don't think we're ready for. I'll tell you that much. But so that was where my head was going.
Okay. So do we agree that, okay, let's just do a simple example and just tell me where I go wrong. Because I'm not necessarily saying something like Elon Musk, who might be worth going on $300 billion, should not have to pay taxes. And I'm not saying that some of the taxes from his camp, shouldn't it be used for infrastructure programs that allow disadvantaged kids to go to preschool? Like, I don't really think anyone holds that belief. So, as I see, when you talk about what you're trying to accomplish here, what I think they were trying to accomplish is generated more tax revenue to pay for a $2 trillion spending
so
package.
it's the economy. Basically, it's like a rather myopic focus on supporting the future economy.
And so Elon Musk owns, I believe it's about 21% of Tesla, right? And Tesla is now $1 trillion company. If you have a tax like this and you say it's a billionaire's tax, and what tax rate do you want to use for conversation's sake, Douglas? Do you want to say 10%?
Sure. I mean, I think when Sanders and Warren came out, which is unconnected to this, earlier this year, it was like 3%. Like it's a low single digit, but we can say 10% for math simplicity.
Yeah, let's just say 10%. So let's say Musk has, and we'll round all the numbers. Let's say he has roughly 200 billion in Tesla stock that he hasn't been selling. He hasn't. I don't think he's sold a share. I can double check that, but he hasn't been selling. If you have a forced tax event that says, "Hey, we're going to charge him $20 billion next year," where does he get the $20 million from? The only place where someone could get $20 billion, and there's only like 5 people on the planet that could actually get $20 billion, is to sell the equities, right? So that is actually fundamentally changing the value of his company because you're causing a forced sale. That's the part that really fires me up. Like, and then let's talk about this because I think people lose track of this. One of the reasons Tesla's stock price continues to go up and up and up is because there's strong demand and there's pretty much no one selling it. Well, one of the reasons there's pretty much no one selling it is because Musk has a ton of the stock and he's choosing not to sell, which is actually an irrational decision, I would argue. Multiple years ago, when the stock price was at $130 a share, which is like 6x ago or something. I don't even know the current share price. It's a long time ago. And he said the stock price is overvalued. So most people would go, hey, the stock price has been overvalued for 3 years. I'm going to be dumping shares. He hasn't done that because he doesn't need the money and it's a fun, like, he likes the company and he's just wired differently, right? I just think this messes with capital markets in a way where the cons outweighs the pros. I just really can't get on board with this.
In the math and example that you just laid out, it makes sense, right? But the actual numbers end up mattering a lot.
Oh, they matter a lot. But
right?
But then the flip side, Douglas, is how do you handle unrealized losses? So in 2022, if the value of Tesla stock gets cut in half, which could very easily happen, does that mean Musk personally has this massive tax credit and he's never going to pay taxes for the next 40 years based on the tax credit he got from the unrealized losses of this? You can't do one side of the equation without the other, can you?
Yeah, I mean, but potentially, I mean, that could be it. There's probably some carryover, right? Just like you having capital gains. I mean, I could see that. I think that the numbers matter a heck of a lot, and there is a, for folks thinking about this, there's a tangential precedent for something that we do in this country right now is property tax. If you own a home, that is, you're not selling your home and then having to pay on that. There is a small percentage of the value of the home, and that's not the increased value of the home. It's the value of the home that you end up paying, right? And so that is a version of a wealth tax. So it's not a fully unprecedented thing that we have right now. But I agree with you. I mean, I agree. I agree with that statement, and I think that the money, like the actual figures, end up mattering a heck of a lot. Because even in what you were saying, so if $1 trillion, his value is 200 billion, and of that 200 billion, it's been 50 billion is like the increase in value, and so then you have to look at like the percentage of that.
Yeah.
And does he decide because not to sell, but because the rates are like interest rates are so low right now that actually I'm gonna take out a collateralized loan and end up paying it? I don't know. I mean, it's like the numbers are so big that you're right when there's such high concentration in the stock market, and then you have people selling high concentrations of that stock, of the highly concentrated stock market, the capital markets go buck wild.
Yeah.
But my point was not necessarily, I don't know where I stand probably on this.
Hmm.
I think if we were to do something like this, it should have pretty tight guardrails of saying, like, we're trying to pay, to your point, we're trying to pay for this infrastructure bill over the next few years. So like, we're just going to do this once. Like there's like a one-time special dividend that the people that have made a lot of money off the pandemic when the US has not made a lot of money have to pay, like, or something. I'm not going into the detail,
Yeah.
but it seems like we're just trying to support the economy. And so if you name the goal, it's easier to figure out the guardrails.
I understand where you're coming from. I don't hate the concept, but I think the actual implementation is just impossible to do in a way that's practical. So,
Yeah.
speaking of how much money Musk has made this year, he's made about $120 billion. That's more than Warren Buffett, Bill Gates have made in their entire lifetimes. I mean, that's crazy. And that's where proposals like this get floated. But that's because he happens to own more than 20% of a
Yeah.
$1 trillion company. This has never happened in history to
Yeah.
this point. It probably won't happen again. And again, if he was acting rationally, he would be selling some of that. He's not. I think anytime you create a substantial tax that targets 700 people, and these are going to be the people that are, in some cases, like cult superheroes in terms of business icons. What's to stop Musk from moving to Mexico over a tax like this and taking his helicopter back and forth over the border to Texas or whatever else? Like, I think you also potentially alienate some of your best business talent.
Yeah. Templeton.
Yeah, right. He left, and
Yeah.
I think you'd be effectively saying, "Oh, these are by one measure the 700 most successful people in our economy, which is the best in the world. Now let's find a way to get them to leave." I don't think that is
Yeah.
what we want to
I
do.
hear you.
Thanks for listening to my rant on that.
Yeah.
I'm done now.
All right, I have one last thing in my fishbowl that I'm going to
Yeah.
dip into. Speaking of wealth creation, there's a post that came out, a history of wealth creation in the US equity markets on Alpha Architect. And this referred back, this is like pure Dougal style type of research. I love this stuff. I was looking at this and I just went, like these people know what they're doing. So this paper that they're referring to was one that came out earlier this year called Wealth Creation in the US Public Stock Markets 1926-2019. So the post that they put out on Alpha Architect is kind of like a summary and some reflection on this paper. To give you some of the context on what the paper looked at, it looked at the 26,168 companies that were publicly traded in the US since 1926. Looked at their cash distributions, their capital appreciation, and was basically at the high level saying how much wealth has been created in the US stock market during this time period, and then did some cuts. So I'm going to lay out some of these cuts, and I'm going to throw in a little quiz for you because it's just fun. So don't, if you're trying to cheat, don't do it. I'm throwing a little quiz for you. So some of the facts: the majority of stocks, not surprisingly, reduced wealth creation during this period. So it's 57.8% that would have reduced wealth creation. And aggregate wealth was concentrated in a relatively few number of high performing stocks. And this concentration increased over time. So an example they gave was in the last 3 years of the study, which I think was 17, 18, 19, 2017, 2018, 2019, 22% of the net wealth that was created came from 5 companies. And 2 companies accounted for 10%. So just some examples. The longer term examples of that concentration were what really got me going, got my eyes going big and whatnot. Because this reminded me of, I don't remember which episode it was, but one of our earlier episodes, we went through the number of companies that have been the best performing company. Like if you look year by year up to that date,
Yeah.
and there are very few, right, that have held that ranks. That gets to the concentration piece. So of the 86 top performing stocks over the entire period, so if you look at the 1926-2019, the 86 top performing stocks, what percentage of the wealth created during that period came from those stocks? And as a reminder, so there were a little over 26,000 total companies looked at. 86 of them created what percent?
Of the wealth creation, I'm going to go 72%.
Not quite that high. It was half.
Okay.
If you look at the the top 1,000 stocks, it was all of it.
Yeah.
So of the 26,000 stocks, 1,000 of them were all of the wealth creation. Second little quiz for you here. If you look at wealth creation by industry, I don't know if they did SIC codes or what they did here. Innovation's not one of them. FYI for Kathy Wood, if you're looking at this, innovation is not one of the industries. So
how's it going, Kathy?
Yeah,
thanks for listening.
So of the industries that are listed out, they have 11, one of which is other. But what do you think is the highest industry of wealth creation?
Let's go finance.
No, that is an industry though. So well done. So technology was number one with
Kathy Wood. Yeah, there we go, Kathy.
Sure. Okay, innovation. So 19% of the wealth creation came from technology. There was this other point of like data that they brought up, which I also thought was like an interesting way to look at this, is they looked at the ratio of wealth creation to the number of firms that were actually in that industry. And that's a different view. And so the highest there was telecom. So telecommunications companies had a 1.77 like ratio of, so they have the like a lower relative percentage of the total number of companies, but a higher percentage of the wealth. And so like pharma fell into that, telecom fell into that, utilities.
So that means wealth per company. Right? Exactly. I mean, I'd argue that like, so what you're saying here is lifetime wealth creation in technology. It just means there were more firms in technology creating wealth. I would argue the right metric is that wealth created per firm thing, which would put actually telecom on top. But to be fair, finance is up there. Actually, no. What's interesting, finance is up there on the gross number. It was 15.2% of the wealth creation, but its ratio per firm is really low.
I mean, a part of, depending on who you put in there, a part of that could be that financial companies got like obliterated during downturns. It's like the amount of negative wealth that came from those. Like if we went back to the 1980s, let's just say like before the savings and loan crashes that happened, you might have had something very different there. But then after the 1980s, if you're looking at 1992, you're like, oh, they all got obliterated. 2008, finance companies got obliterated, right? Like I think that might be one of the factors going in there. So,
well, yeah, you have the leverage piece in there, and then who knows if this includes like it would, I guess, publicly held community banks, anything that's publicly listed. So there could be a lot of really small financial institutions here.
Yeah. So I had fun with the research and the data. The point of the post that Alpha Architect put out here was look at these numbers and then go tell me you're about to go buy individual stocks. I dare you. Like that's basically what they were saying, and not those words. They were just saying individual stocks are not for your everyday investor. They are dangerous. This is where indexing comes for your everyday investor. Indexing is a much better idea because the returns that end up coming in the long run come from such few firms that you either buy those firms or it's no bueno type situation for you. So buy ETFs. That was kind of the point. I thought the data was pretty interesting here and worth a read.
Yeah, this is good. This is Larry Swendrow, who's super bright. And sorry, Wes and Ryan and team at Alpha Architect, I'm still gonna buy some individual stocks. But
I'm all up in the. Not only am I going to buy individual stocks, I'm going to have a concentrated portfolio of individual stocks. So like,
not for your average investor or your amateur investor for sure. Can we jump to one more thing in my fishbowl?
Yeah.
So I saw this graphic this week, and I know I sent it your way. It's from Visual Capitalist. I think I came across it on Twitter. It could have been some other social media, right? It's the world's 100 biggest companies. And I don't want to dwell on it, but they break it down by country. And so basically there's like 10 in China, a few odd ones in Saudi Arabia, India, France, Ireland, you name it, Switzerland, whatever, Germany. And then I think the number was 44 in the US. And so my first level reaction was, wow, that's crazy. I had no clue there was that much dominance with U.S. companies. I think my second level reaction is actually more interesting, I'd hope. It's to me, this articulates another point about how the U.S. stock market is overvalued, because this is the height of. So the U.S. stock market is something like the third most expensive stock market in the world. Basically, European markets, Asian markets over the last 10 years have had trials and tribulations that the U.S. markets haven't had. They're just going up and to the right. And this graphic, in a way, speaks to that, because all these companies here haven't really come back to earth. I think they're on the high side of their fair valuation.
Yeah,
You
very
think
true.
I'm onto something here?
Are you on to the fact that the US stock market is overvalued? Yeah, this actually, it takes me a little bit back to the conversation we had with Adam Burrows of Rain Ventures back
Yeah.
in June, maybe. And that was around the Berkshire Hathaway annual meeting when Warren, my boy, I just call him Warren, because you don't like how I say his last name sometimes. But my boy Warren, he pulled up from, I think it was either 88 or 89, pulled up like the highest market cap stocks back then, and it was basically Japan. Like, for the most part, I think he pulled up the top 10 or top 20, and it was like just ruled by Japan. And then from this past year, from 2020, it was ruled by the US, right? And one of the things that you brought up then was, you said, and if you go forward another 30 years, 30 years, what country is going to be?
Yep.
Right. And so agreed, we're definitely overvalued. Sorry, the US stock market is not undervalued. I'm saying that. So the US stock market is definitely overvalued, and it is fascinating to see what's going to be. Facebook might be charting its own course as to not be one of those organizations right now, potentially by going meta. And then you've got Microsoft, Alphabet, Apple as like the other big ones. Where are they going to be? Microsoft is strong right now. Wow. I mean, it's just that company is hotness right now.
Well, I want to tell you that I don't think Microsoft's overvalued, but I do think, and this is going back years, when companies were just crossing the $1 trillion threshold in terms of market capitalization. You'd look at someone like Apple, and their revenue streams was so concentrated with iPhones and a few other things, and you always looked at Microsoft, and their revenue came almost in equal parts across 5 different business units. Like, it's a really impressive, diverse revenue stream that I don't think any of the other companies that large can claim. So there is something to be said for that.
Yeah, we will see. Crescendo or not crescendo?
Yeah,
that's the question.
Fun week regardless. All right, guys. So Dougall's hooked up a new Substack. It's Skippy and Dougall's at Substack.com. Good content on there. Please check it out. We're on Twitter at Skippy Dougall's. You can email the show, skippydougals@gmail.com. And thanks for listening. Am I missing anything else, Dougals?
Oh, no, but skippyanddougals.substack.com.
Oh, thank you.
Do not email Substack with our handle.
Please rate and review the podcast if you get a chance. We appreciate that. Thanks for listening, guys. Peace.